is Tuesday, April 8th, 2025. We are talking about the tariff crash that's been happening over the last few weeks. So let's go ahead and get started. Again, please answer or ask any questions throughout. I don't mind pausing the presentation to ask questions. If you're thinking about it, I'm sure others are thinking about it. And like I say, that's a big part of why we want to do the live webinars, is to get your feedback, get your questions so we can answer it. And then when we post it the next day, I'm sure other people have the same questions. So we try to cover a lot that we think you might be thinking about. But again, just reach out with questions anytime. And we can do that in the chat function there. So, and I think there's a Q&A function too. So Whitney will be monitoring that. So let's go ahead and get started. We're going to talk a few things today. We've had a very violent decline, especially the last few days, Thursday and Friday mostly of last week. So it begs the question, is this a V bottom? Because you need to have we've got the left side of the V. The question is, are we going to have the right side of the V, which is the strong rally back up, or is it going to develop more into a complex correction where it might have a retest of the lows? Based on what happened today, kind of leaning towards the complex bottom, but we'll take a look at it. Rising interest rate and inflation cycle, we'll talk about that. Sentiment analysis, bond yields, again, that next cycle. And we're going to go over some tariff winners and losers, kind of look at the influences of tariffs and what companies or areas of the market might be positioned better than others. So let's dig in. S&P 500, one of the things that we've been noticing a lot is, especially with the way the market behaved late Friday, yesterday, and today, a lot of overlapping price moves, and it's starting to have a very similar look and feel to COVID. The feel similar to COVID is really, it's an unknown, unprecedented, somewhat out of left field issue that the markets are dealing with. COVID came in, and obviously we know what happened there, but it was a 40% market decline. This bottom chart, this is the S&P 500 top chart, shows the move over the last few weeks. This bottom chart is March of 2020, and it shows the COVID crash. This was a much bigger crash. It was about a 40% decline. We're at a 20% decline from peak to trough in the S&P right now. And 10% of that happened Thursday, Friday. So a lot, a very quick move. The similarities with COVID, the fundamentals are uncertain of how they're going to be influenced. There is not a set tariff rate. The market is trading on the Trump negotiation tactics, which are not exactly calm, or some would say sane, but the goal, I think, is to try to eliminate tariffs, or at least get it to where it goes down. And there's uncertainty around it, and there's not a specific playbook to use when dealing with it. Same thing in COVID. Global pandemic. We haven't had a pandemic since 1919 or 1920, the Spanish flu pandemic. But the signals still worked pretty well because the human behavior was similar. With COVID and with a lot of these sort of post-crash bottoms, we tend to see volatility elevated for an extended period of time. That doesn't necessarily mean that prices are going to continue to go lower. With everything that we're seeing, all the data points that we're looking at right now, there could be some further room to go down, but we should see a bounce, and see a pretty strong bounce to develop from these levels. Possibly we go down and get a retest. So let's look at more of these V-neck bottoms. When we see these fast declines, and a 10% decline in 2 days, I mean, that's a mini crash. There's been 11 times prior to this that we saw kind of this waterfall decline to sort of a big, this is a 30% decline from recent highs. We're at 20 right now, but 32, if you look, and the important part of looking at these charts is the left side of it going down. So that's all that we know. That's all the information that we have for the current market cycle. We don't know how far that left side is down along the path from 0 to 100%. 100% would mean that we saw the low yesterday. If it's 50%, it means we have 40% total decline, 20% more to go. But I really doubt that, frankly, with the data that we're seeing. But what would not be ruled out is more of a complex bottoming process. And what we really mean by complex bottoming process is sort of this bounce off of a low. So yesterday's low was an intraday low. We actually closed lower today than we did yesterday. So this is the lowest close of the decline, but we actually had lower prices yesterday morning. So going back and retesting these levels throughout this week would be completely normal. If we look at some previous times where we saw a retest, there was a couple of retests here in 32. Again, one of the comments that I kind of get often is, well, each cycle is so different. Like with such a different society, different financial products that we're working with, different influences, a different world, but we're the same humans. And that's a stock chart is a visual representation of investor feelings towards that stock. That's all it is. Now, the investor feelings are influenced by earnings. They're influenced by the strength of the company, the market share, what kind of moat they have around their business, the management team, all this different stuff, but it's still influencing sentiment. And that's really all that's happening in markets. It's a daily gauge of sentiment. Over time, the sentiment tends to match the fundamentals. So you have a company that's generally, rising revenue over time. There's periods where investors get very optimistic about it and the price goes up unjustifiably based on the fundamentals. And the same thing, the price goes down unjustifiably by the fundamentals. In COVID, we saw it go down unjustifiably based on the fundamentals. Now, it also was helped by trillions of dollars that started to be printed later in the year. So we can't factor that out. But all of these V bottoms, we didn't have trillions of dollars printed. We just had that in 2020, maybe 2009. But if you look at the shape of those with the current, our new space age technology and all the things that we have as a new society, those patterns are pretty similar. 2009 was very similar. 2002 was very similar. Here's 87, the 87 crash. We're seeing some similar stuff today as well. It already happened. We already saw the crash. This was the low point. It didn't revisit. It has never revisited this level. So the low point after the 87 crash was a fantastic buying opportunity. Like I said, we've never even come close to retesting that level again once it started to move. All of these look almost exactly alike. And we go back further, 42, 62, 70, 74. All of these look very, very, very similar. Even these that have the retests, we saw a big decline, then this chopping around, big decline, pretty clean retest, big decline, fast retest, big decline, super fast retest, and then it's sort of floundered around here. So we can see similarities in the chart patterns just by visual inspection. So these other times, we saw massive recoveries in all of these. The sentiment and the data that we're showing right now are very similar to these other areas. So let's keep that on the front of our mind. We're going to go a little bit more detailed. I've got a couple of detailed charts to look at the technicals kind of near term to see what we're looking at and what might happen. So here, this is looking at, this is the NASDAQ and this is the S&P. So this is the QQQ, and what happens here, this is the last few days. So this is sort of last Thursday through today. This is COVID lows. So, or excuse me, this is the lows from last summer. I've got a lot of different charts that I've been looking at the last couple days. This is from the yen devaluation trade last summer. If one of the things that people don't really remember is that the VIX actually spiked higher than it is today, than the max reading that it got to yesterday. It got up to over 60, almost 70. The VIX spiked to over 60 yesterday and has fallen to in the 40s now. But what we saw is this sort of a retest, and this line right here is the average price based on volume trades since the low. So all trades that have happened, this is the average price of those trades. This is an interesting chart to look at, or a data point to look at the chart, because what you can see is people that are buying down here, or people that have sold or are selling. This is their average price. So if we come down, we had a test of this, came back down, had a little test of this, and we saw buyers show up around where the average price was after the low. After that happened twice, we saw really buyers step in and really take off. This initial move got up to this gap that filled this gap right here. This got up to the start of the gap recently, and then rolled over, headed down towards this VWAP, volume weighted average price. So, we're seeing some similarities through last summer, and last summer was very much a technical trading environment. A lot of similarities to this today, because it was fear last summer and COVID. Last summer, it was fear of what's going to happen with the Japanese yen, and if this carry trade was really going to unwind a lot. We saw technical selling. Once that technical selling was done, we saw the markets move higher. We could be seeing something similar right now, but it's definitely shaping up. The pattern is shaping up very, very, very similar to last summer. S&P 500, pretty similar. So what we look at is these patterns. This was a little bit slower decline. It was a 10% decline. We saw initial bump, fall back and retest the lows, and then it was off to the races. Here, this is the this is the NASDAQ as well, a little further out. So what we saw, this was the S&P. I'm sorry. Big decline here, pop up, kind of a retest. So, pretty similar to last summer. That's a positive so far, but put it in the should be bullish camp. Another should be bullish camp, VIX. So we shared this yesterday in the report. Typically, when we're seeing spikes above 50, they've been major lows. And we saw it above 60, right at 60 yesterday. Out here to the right, this is that Japanese yen carry trade sell-off. It wasn't as fast as what we see now, but it was a very fast, very quick, very technical sell-off. COVID VIX spiked up to almost 90. Again, very fast, very technical, very uncertain environment. What we've seen with the VIX spiking up to 60, there's only been 3 times that the VIX has gotten higher over the last 30, 40 years. That was last summer, COVID, and 2009. So this is pretty rare air that we're kind of breathing in here. It's panicky. It feels bad. This is not a selling opportunity. This is bearish. This is individual bearish sentiment. This is what we're all feeling. This measures individual investors and asset allocators, what their bullish bearish sentiment is. Sentiment is consistently a contrarian signal. So you get a lot of bears, you get a lot of negativity spike higher. That's typically associated with a low point. Sentiment is driven by price. Sentiment doesn't drive price. Sentiment is driven. So as price goes down, sentiment goes down and gets more negative. So that's why when you see extreme pessimism, Bottoms in markets tend to be more events, not processes. Tops tend to be more of a process, not an event. So typically, when we see these spikes, they're V-shaped. They might bounce around the bottom. They could make another new low and get some divergences in place. But typically, what we're looking at is low point. We've got the most bears since the low of 2009. So it's people are more bearish than the 22, 23 bear market, more bearish than COVID, not as bearish as the low point in 2009. But kind of going back to the tech bubble, it's about the same as the tech bubble in the throes of the tech bubble. I think we can relate some of this or contribute some of this to technology. We just have much more speed to ingest information and digest information. But again, we're the same humans, and when we see these pessimistic spikes, there is a lot of valuable information there, and it's typically very, very bullish. The same can't be said for optimism. Typically, you get optimism and have a lot longer to run. But typically, pessimism is isolated and spikes and tends to be lows, and that's what we're seeing right now. Put call ratio. So this is another thing that we want to look at to see, is there real underlying concern? We're not seeing that much out of the put call ratio. This can actually be a little concerning that it's not concerning. We'd prefer to see a big spike higher, but if we look, we got to at COVID, we got to about 14 on this, which is the number of puts versus the number of calls. Put being a bearish bet, a call being a bullish bet. So we've got a spike higher, but it seems more like this is a retail investor selling in a panicky. The big money, not so much. We're actually seeing some of the big money come in and nibble a little bit. Credit spreads, another thing that we really like to look at a lot. Credit spreads are a fantastic way to look at the market's perception of risk by looking at junk bonds versus treasury bonds. And so what we're looking at here is credit spreads for 30 years, going back to 95. The average is 500 basis points. This just means the average junk bond has a 5% higher yield than the associated maturity of a treasury bond. So if it's a 10-year, typically 10 years, you're looking at a 10-year junk bond, 10-year treasury, and the junk bond should be paying 5% more per year. When it gets low, we're down to 259 basis points, 2.5%. That's pretty low. And we're up to 445, 450, not even back to what the average has been over the last 30 years. So this has been a spike higher, and we have to watch it, but it just doesn't look overly concerning at all. Here in COVID, even halfway through the decline, we're up at almost 700 basis points. So 6, 7, 8% above as opposed to 3. Now we went 2.5 to 4.5. That's just really not that concerning of a development, but we have to watch it. Treasury yields, another thing that says, well, it's just not as bad as it feels. Looking at treasury yields, so typically we see a flight to safety when we see a real market regime and a market regime change. We saw this, big decline kind of with the bear market in 2018 and COVID down here. Yields really collapsed, got down to a very, very low point. This looks like it was the low point of the cycle. And this, we've thought that we're entering into a higher interest rate environment and a higher interest rate cycle. This just adds fuel to that. This helps confirm that we could be entering into it, and it says that we are probably entering into it. What we would see if we see a 20% market decline in a very short period of time, and especially if we look at last half of last week, Thursday and Friday, we would expect to see a massive move into treasuries and see those yields go way down. We have not seen that at all. In fact, the moves we're seeing in treasury yields, the 10-year yield went down quite a bit, but the 30-year yield is just not moving. And the movements that we've seen so far really just not anything abnormal than what the normal, kind of day to day, week to week fluctuations are in the yield. So we would expect this to go way down here. I'm surprised that we didn't at least get 4 on the 30-year. And most likely, I'm a little surprised that we didn't get 3.5 or 3, given the extent of this crash. So that's actually a positive. It's a positive for the market near term, and it also confirms or at least supports the thesis that we're going into a higher interest rate environment and higher inflation environment. I'm going to take a little break. Do we have any questions here, Whitney, by chance? Um, Ping me if we do. Go ahead and feel free to ask any questions as we're going through this too. No questions so far. Good. So here, the big news recently is China and tariffs relative to China. We got a little taste of this with the Japanese yen carry trade, that currencies definitely can. And if you do have questions, if you could just type it into the chat, or the Q&A. I don't think we have it available to open the mic, but if you want to enter in the question into the Q&A or the chat, we'll answer it either way. So what we can see here is that what this is the treasury yield, 10-year treasury yield in black, and the 30-year treasury yield in black, and the Chinese yuan in sort of this reddish purple color. What we can see is kind of July of 23, really when overall data started to improve and the bull market really took hold from the 22 bear market, sort of that, summer of 23, we saw a correlation. So treasury yields in the Chinese yuan were moving up and down. There's reasons for this. China is a big buyer of treasuries. So as the yields go up, they could be buying it and moving money out of the Chinese yuan into the U.S. dollar. That would cause the dollar to strengthen against the yuan. That would be Chinese money flooding into the U.S. buying treasuries. That would, like I say, push the yuan down, and push the treasury yield down. As the treasuries go down, taking profits, they start to move it from the U.S. dollar and the U.S. back into China. That puts downward pressure on the U.S. dollar, upward pressure on the yuan. Same with yields. So what this tells us is that the Chinese have been really driving a lot of this treasury moves. And it's interesting that there was such a big disconnect here prior when we're looking at the bear market. And we've got this massive disconnect now. This is a really interesting move. Yields going up with the yuan going down says that China could be selling their treasuries. I think that was probably going to be something that is a persistent thing. It has big but consistent upward pressure on inflation. Wondering why yields haven't gone down in this cycle right here, at least in this mini crash that we've seen. I think this is what we're seeing. We're seeing money go out of U.S. Treasury, especially from China. I think that's going to push yields higher. That's just incremental upward pressure on yields. If you have trouble, and we saw some treasury auctions that weren't fully subscribed. We've mentioned this kind of last summer, about a year ago. that there's going to be some funding pressures in U.S. Treasuries. There's a lot of I'm sorry, I was looking at a question. Let's see here. Let's see. Oh, Q&A. I need to get into the Q&A. Where is that? There it is. Okay, good question. If investors are not buying bonds as a flight to safety, what are they buying? Well, they might not be buying anything. There is quite a bit of cash on the sidelines. There is money moving into some commodities. We've seen gold do pretty well. We've had gold in portfolios for a little over a year, about a year and a half. Been a nice trade for us. I think that's going to continue to do pretty well. It looks like all the things that are happening right now are inflationary, but they haven't been buying U.S. Treasuries. They could have been buying foreign. There has been a nice move. Of course, that was in the last week. We've seen a big sell-off. It's not buying a whole lot. It's not really moving into a lot of places. It could just be moving back into China and into cash. But I haven't had a chance to really look at that, but that's a great question. Um, Interest rate cycles. We've shared this chart quite a bit. I hope that answered your question. I know it really didn't answer the question. I'm sorry if it didn't. But we're not sure. It's just not. They're not buying bonds. They could be buying corporate bonds. What's another thing is you look at the high yield bonds and their spread is going up a little bit. Corporate bonds relative to treasury bonds, those haven't moved hardly at all. So we could be seeing some money flowing into corporates. That would be a reflection that Trump distrust, U.S. government distrust. I don't think we should be worried about the U.S. Treasury. I do think we should be worried about the Fed going away, which it probably should. But, anyways, bond cycles. Speaking of buying bonds, we do think bonds will become a much larger portion of client portfolios going forward. Initially, early this year, it was looking like we had a year or two left of this bull market. We may still have that. This does look like it could be a temporary decline. I think all likelihood is it's a temporary decline, but there's a lot of things that could happen. And we're not going to, that's what the data tells us is that we should see a big snapback. We're going to be watching very closely. Going forward, looking a little bit longer term, we've talked a lot of short-term things about what the market may do following this mini crash that we saw last week. But longer term, what does this mean? Really longer term, it just confirms our thesis that we are entering into a rising interest rate, rising inflation cycle. These are very long cycles. We've talked about this one-on-one with clients, talked about it quite a few times in reports and in some webinars. We'll talk about it again. Interest rates are the tail that wags the dog in global finance. And relative interest rates are probably the most important data point on the globe. It drives currencies. It subsequently drives a lot of the earnings potential for big companies that trade outside borders. So it's a major deal. And what we've seen, if we look at the chart here, one, this is where the Fed was established, right here right before 1920. Since the Fed was established, we've seen so much more volatility in inflation. So what we could see here, but we've got a 30-year cycle, 30-year cycle, 30-year cycle. This one was a little bit funky, not quite as this Mexican war kind of threw it off. 30-year cycle, 30-year cycle. I mean, that's going back to 1770. It's because human beings are the same, have the same behavior. That's the lesson. So here, as we believe we're this is a catch up trade because we're 40 years into a 30-year cycle. This peaked in 1982 and it bottomed in 2022. So 40 years into a 30-year cycle. I think this big pop higher from 0 to basically 5% um, is a catch up trade because the Fed kept rates too low too long. These cycles are not going to go straight lines. So we don't see just vertical, no volatility. This is about as close as it gets. So we should expect interest rates to chop around quite a bit. But generally, we think this is going to be moving higher. If we look historically, 8% was kind of the peak that interest rates got to, this Mexican war, and then inflation of the 70s caused by the Fed. That sounds familiar. So we could be seeing some spikes here, but I do think that we're going to get kind of the 6 to 8% yields in the not too distant future. That's a fantastic opportunity to reposition. If we can get equity returns in fixed income, that is what we're looking for. And I think we're going to get that. So we've got some volatility right now. We're kind of max risk right now. The plan is either if things really deteriorate and this crash is not over, we are going to raise a little more cash. We did raise a little cash, sold a couple of positions today to free up some cash and kind of upgrade the positions. We don't expect that staying in cash very long. So you'll start to see a little bit more movement in portfolios as we get further away from the crash and things start to calm down. Okay, so got another question. How does the analysis of data points from historical declines correlate to today's environment? It appears that the market is at the mercy of Trump's tariffs. Is that not entirely the case? Great question. This goes to what we're seeing in the market is a reflection of human reaction to what's happening, not what's happening itself. There is a intermediary in markets, and that's humans. So you've got financial developments, political developments, wars, depressions, recessions, growth, innovation, productivity gains, all these things. It's not physics because those things aren't direct inputs into the market. That's where these people really get, especially when it comes to sentiment ratings, people get confused because there's not, just because GDP goes up or just because earnings goes up, there is not a direct tie to that. Like if I pick up my phone and drop it, I know what's going to happen because I drop it, gravity acts on it, I catch it. Gravity is that force is directly acting on the phone. Market dynamics are different. There's a human intermediary. So you've got event or, situation or environment, developments, conditions, whatever you want to call it, whatever this environment is then subject to the flawed interpretation of human brain, and then they determine what they're going to do and then act. So the direct input is the action of the human into the market. That is where sentiment comes in. And that's also why fear and greed are so important. It's also why we get these moves that aren't directly tied to fundamentals. It's why we get the tech bubble. It's why we get the tech crash. It's why we get a 10% move in 2 days out of nowhere. Did fundamentals change by 10% over those 2 days? No. Maybe they did, but it's the human interpretation. Also, you could replace interpretation with fear or greed. It's the human's interpretation. So are they reading it fearfully, or are they reading it greedily? And that the human behavior is what drives markets. It's flow. Markets on a day-to-day basis is buyers and sellers, period. Um, so it's that human intermediary that is the tie, and it's also why previous cycles are applicable to today. It's why they rhyme and not repeat. So it's this human intermediary that we have to factor in when we're looking at market moves. Good question. But we do think we're entering into this cycle. We think it's going to be a long cycle, and we think it'll be a good cycle for the right portfolio. And we think the right portfolio is going to be a much more conservative portfolio. Although we do think software, some tech, we'll talk about this in a little bit, could benefit from a tariff environment. Um, Again, looking at previous cycles, we talked about this in the last webinar. Looks pretty similar to the 1960s. This was the 22 low. The black is the S&P 500. Currently, this is through kind of last fall. We have seen this start to go down here, so we're kind of back down this. What the 70s was characterized by a choppy market. They're about 20 to 30% declines, and it was sideways from 1968 right here to 1982. So 14 years it was flat, and we're following it pretty darn well. And if we're going into an increased inflation cycle, increasing interest rate cycle, we definitely could see this start to rhyme for sure. Do have another question. Computer traders algorithm. That's true. There are influences that are not human, but human create the algorithms, and human create the levels at which to trade. So you still have human influence even in the algorithms. We use algorithms, but algorithms that we use are based on the things that we wanted to seek out. So algorithms and computers and trading, uh, formulas, they're not perfect either. So markets are very, very, very complex. Trying to boil it down to its simplest as possible. Like I say, it looks like there's increased fear over the uncertainty of what may happen. There is the potential for real risk and for the economy to really suffer. And if Trump is a blowhard, and I'm going to just kind of call it like I see it. I've had people tell me that I sound like a complete Trump supporter. I have people tell me that I sound like I don't like Trump. That's probably good. I think they all should go to jail. That's my stance. But anyways, we look at this cycle, everything that's happening right now, deglobalization, tariffs, reduced government spending, Fed potentially having a less important role going forward, if not being eliminated altogether. Massive tax cuts. The thing with tariffs is you have to kind of think it all the way through, and it's not just about tariffs. It's about generating enough revenue and then reducing enough spending that major parts of the IRS can be eliminated, if not all of it. In that point, there is a proposal right now to end capital gains taxes by the end of this year. Whether that happens or not, I have no idea, but that's the end goal. That's also inflationary. If all of a sudden there was, no income taxes, no capital gains taxes, that would be a heck of an economy. There'd be a lot of extra disposable income, and prices and interest rates would go up. So, pretty much all the scenarios that we're looking at, except for a massive deflation, war, economy completely goes into the dumps, which is always a risk, and that is on the table right now. But it does not look like the likely scenario, but we can't rule it out by any means. What does look like a likely scenario, in our opinion, is just a wet blanket over the economy and over stocks. You know, interest rates, higher interest rates compete with flow into stocks. And the higher that interest rates go, the more competition for funds interest rates have relative to stocks. That reduces demand in the stock market. It reduces the upward pressure on price. That's why we had this choppy sideways environment in the 70s, the last time we saw a rising interest rate, rising inflation cycle. And again, in the early 1900s, saw a 15-year period with a 1% annual return because interest rates were competitive. It's about flow. It's not about earnings. It's about flow and sentiment. And so this is supportive of this rising interest rate cycle with what it means to all of us on this call and listening is there's going to be opportunity to de-risk and probably improve returns in the next, we still think, a year or two. So let's look at who may benefit. We're just about done. Few different things could happen. One, you want a domestic focus. So that's pretty simple. If you've got tariffs, if there's friction to sell or receive from overseas, a market-based economy, a capitalist-based economy should be responsive to that. So, the tariffs are trying to, or at least and I'm not supporting tariffs or not supporting tariffs, but what they could potentially do is create opportunities with more domestic based companies. So small caps, mid caps, companies that don't sell a lot overseas, or if they do sell overseas, they don't have a lot of tariffs to deal with or currency fluctuation to deal with. That's the other side of the tariffs, is that having the currency fluctuations. If the dollar is declining, that could help a larger multinational company because their overseas earnings have more favorable treatment when the dollar declines versus that foreign currency. So there's an extra earnings bump that happens when you have a US dollar that's declining against the currency of the country that you're selling into. I think I got that right. So if you can eliminate that friction and eliminate that and just sell within the domestic borders, you don't have to worry about that. I think what we're going to start, we've been saying for a while, we think small caps and mid caps are really positioned well to benefit. It hasn't happened yet. And they've been hit this year, and they got hit with this pullback, but they look really attractive. The valuations, earnings growth, tariffs, all these things really support small cap for the next few years. Mid caps as well. The other thing you look at are firms that can pass through costs. So pricing power. We're developing some scans that look at that. Don't have all the data points just yet, but that's going to be an important thing as inflation happens, as volatility of prices from currencies happen. A company's ability to kind of rapidly adjust price to their inputs, to their COGS, the cost of goods sold, is a huge advantage. So, more dynamic, less capital intensive, are typically gonna do pretty well. Also, when you start to look at the movement of goods and services across the globe, that's where you start to say, okay, if there's going to be a cost prohibitive barrier from a combination of tariffs, currency risk, sentiment changes within countries of buying, Chinese consumers might not want US goods. They're probably too expensive anyways, except for maybe an iPhone or something. But some things may come out, but materials should do well in an inflationary environment. It also should benefit from tariffs by restricting more of the movement of those metals and of those materials, and increasing price, which increases profitability for those companies. Materials are actually starting to perk up in our system too. So it looks like we'll get a materials buy here in the next week or two. Industrials, again, same sort of thing. If we look at the semiconductor bill from a few years ago, there's a lot of semiconductor manufacturing plants that are popping up in the U.S. That supports the industrials, the Caterpillars, Honeywells, things like Texas Instruments, kind of lower end semiconductors. So technology, especially software, we've got quite a big focus on that with portfolios. That's been really perking up in our system. And energy could, if inflation happens, energy will do well. If deflation happens from a weak economy, energy will not do well. Okay, then the last slide, we shared this last time. And we have not changed this slide. So expect a confusing environment. I think that's a check. It's confusing to a lot of people. Narrative risk is very high. That's what the market is trading on, is narrative risk. It's what's the tariff going to be today? What's the tariff going to be this hour? And that's causing this volatility. But it's also the unknown outcome and the fear that it causes that's causing the volatility. What we're looking for is there's going to be a point at which people go, okay, this isn't a 20% deterioration in fundamentals. This was a 20% fear trade where the market sold off based on the uncertainty of what may or may not happen, very similar to COVID. So the data points look very similar. There's opportunity in this market. We'll be repositioning and kind of upgrading the portfolio as appropriate. But any kind of major selling, we do think we should wait out this week and see if we get a complex bottom or more of a V-shaped bottom. But I do think we're gonna still see some things come out. There was an announcement that there was some kind of major thing that was found with Doge today, but who knows? But I think we should probably all be happy about that, especially if we can get the cost down and get some tax relief in capital gains, income tax, or both. So we're still in the bearish scenario, full of sound and fury. That's kind of what we've seen over the last week. What we hope is that the bullish scenario starts to come in, signifying nothing. That we see the tariff talk is really Trump, being a blowhard negotiator. With all due respect, I kind of forgot. Oh, then hopefully it's signifying nothing, that it's just a negotiating tactic, and we see these tariffs start to normalize and come down and things kind of settle out. That'd be best case scenario, paving the way for some tax cuts and things like that. But that may not happen. Trump is such that the negotiating tactics are not necessarily real politically satisfying for cooperation. But sometimes you need that. So we'll see. But for now, it's a nervous environment. We definitely understand, the uncertainty, and it's never fun seeing portfolios go down. This was an outlier mini crash that really looks like more of an opportunity than a continuation of something worse. But we're gonna stay on top of it, and really look to see if we need to de-risk in the short run. Right now, the signals are saying no, do not de-risk. We're just repositioning. If we sell something, we're going to upgrade it into something else and not be out of the market too long. Okay, it looks like a couple more questions. When we have fearful investors selling, who is buying what they sold? Good question. So one of the things that you look at is down volume versus up volume, kind of where when you see a lot of sellers, that's why prices go down. Prices go down to entice buyers into filling the sell orders. So when we see a 10% drop over 2 days, that's really a lack of buying. We saw some pretty big selling, which is a good sign. That's usually capitulation. That's happened. But typically what happens is it's whatever amount is sold, however many shares are sold are equally bought. But the buyer is going to wait to a price where they want, where their theory is, tells them to buy. So as you get, each seller has a buyer, but at what price? That's where the supply comes in. When there's more supply than demand, prices go down to fill the demand. And with that supply, when there's more demand than supply, markets go up because those sellers are holding off to a little bit higher price and then they sell. And then it's a little bit higher price and then they sell. And you got a whole bunch of buyers out there just saying, hey, give me market. I just want to go buy whatever I can. The flip side is happening over the last few days. People are selling what they can, and then thinking twice and then thinking afterwards. It's that flow and the even out of flow is what where the price ends up. Does that make sense? I don't know that I described that all that well, but it has to do with the flow and the price getting to a point that it meets the supply and demand curve meet. So another question, for a market to crash, for a market crash to hit bottom, this is something I was explaining. We just need people to stop selling. So what is the action investor that drives prices back up into recovery? Great question. You lose the incremental seller is what happens. It's that ratio of buying to selling is all the market is. When you get down to its very, very, very base level core, what is it? It's an auction. Every stock is going through an auction every minute for that to fill. The public markets, especially in the US, S&P 500, there's so much money trading around those markets that you get some movement around the edges where you get buyers to stop. That has moderate downward pressure. If buyers completely stop, that's when you get these air pockets. And you see a seller going, you know what? I'm just going to put a market sell on Apple stock. The buyer might say, look, there's all this volume all these trades that are trying to sell in the market. And that is information that you can see. All these trades trying to sell, getting filled at lower and lower levels. You have a lack of buyers, but then you throw on top of it selling pressure. That's how you get this 1-2 punch and get a 10 to 12% drop in 2 or 3 days. So what it takes for that to reverse, this is why these different indicators are important. We get to see what people are thinking about other people. So it's sort of the second derivative discussion or a third derivative discussion of saying, okay, people are bearish. A lot of people are bearish. That's historically been a good sign. Better stop selling on the one side and maybe we'll start buying. That's the thought process. So you get these different readings and you can see what everybody else is thinking. You can see what junk bond investors are thinking. Are they expecting to have they want to get compensated on the risk for loss in those bonds? And, 4.5, kind of under 5%, under 5 or 6% spread, they're just not signaling that much risk. They're not signaling that there's enough default risk, enough economic deterioration risk that they're comfortable having a 3 to 4% spread over the safest investment in the world in a company that could go bankrupt. So the nice thing about markets is at its core, the price is the price. It's what people are willing to buy and sell that stock for, period. And we go through periods of overvaluation, we go through periods of undervaluation. And this is a mini crash undervaluation based on fear of what may happen. So it looks like, so kind of to summarize, do we have any more questions? Margin calls. We could see margin calls. We're starting to see those. There's some correlations have gone up quite a bit. That's very normal in crashes. And margin calls could be a reason for that. People were pretty heavy tech. And if they didn't do anything and have some pretty big gains in there could be some margin calls happening. One of the reasons we don't like margin, we don't like to trade on margin. We like lines of credit on margin, but we don't like trading on margin because you can just blow up your account. So margin calls, they happen every pullback. I don't think this one is any different. So not a huge influence on the market. It's really just more around the edges and more of a result of selling. It's not, margin calls aren't any reason that are market driving event, if that makes sense. Good question. All right, with that wraps it up. If there's not any more questions, we'll leave it just for a little 1 second, but thank you for all for joining us today. Hang in there. We don't say this very often, to stay calm and kind of ride it out. We need to ride it out. We don't need to be doing major selling right now. We can do some repositioning. If there is another downdraft, we are close to having some stops, and we're going to get out of this panic situation first. But it looks like on its whole, this is going to be a buying opportunity. If it's a buying opportunity by tomorrow, I don't know. By Friday, I don't know. But I think by the summer and by third quarter, absolutely, this is a buying opportunity. So let's stay in touch. We'll put out reports as we need to. We'll put out some videos. We might even do another webinar if things get crazy over the next week. But we appreciate you. We appreciate the trust that you put in Ironbridge. Please don't hesitate to reach out directly to me with any questions. Jim.denholm@ironbridge360.com is the best. We'll be posting things on website and social media. But we appreciate your time, appreciate your business, appreciate your friendship, and invest wisely. Thanks, y'all.